moving on, telecom major Bharti Airtel has come out with steady set of Q4 earnings. However, it has posted a drop in net profit. Revenue margins and EBITDA all held steady in line with what was street's pricing in. Ansh Bhilwar is here with more details on the number crunching.
Bharti Airtel has reported steady performance for fourth quarter. If we talk about revenue, then that came in at 47,876 crore, registering 6.1% sequential growth in line with our estimates. On profitability front, we are seeing that net profit stood at 11,022 crore, which is down by around 25.4% on quarter-on-quarter basis, but still ahead of street expectation. And this also included deferred tax of around 4,230 crore. Talking about EBITDA, that rose by around 10% to 27,009 crore, while margins improved by around 191 basis point to 56.4%, which is also broadly in line with our estimates. Company's ARPU remained flat at 245 rupees, indicating a stable revenue per user metric, whereas capex during the quarter surged to 14,401 crore as compared to just 9,161 crore in the previous quarter, as the company continues investing in network expansion and 5G rollout. India's mobile segment revenue stood at 26,616 crore, slightly higher than its previous quarter. So overall revenue margin were in line, but that surprised on upside, and company continues to strengthen its capex cycle.
Thank you, Ansh, for getting us that review of Airtel earnings. But moving on, let's shift focus to the auto space then. It's been a smooth ride to the finish line for Tata Motors this quarter. Well, the top line cruised in as expected. It's the bottom line that floored the pedal. Now, profit zoomed past street estimates to over 8,400 crore rupees, marking a solid year-on-year leap. Now, a resilient quarter powered by strong JLR tailwinds and domestic stability. Now, buckle up now as Srishti joins us to break down all the numbers.
The numbers look very good coming in from Tata Motors this time around, and especially look at the margins, because on a consolidated basis, the margins are on the positive side. But apart from the numbers, the big commentary and the big headline is that the company has now turned into the net auto cash positive in FY25. The company has delivered and achieved the target that they have given earlier. And for now, the net cash balance stands at over 1,000 crores is what the company is highlighting. On to the number front, well, of course, though the revenue has come in line to what we were expecting, but a consolidated margin surprise is what we have witnessed. 13.9% is the consolidated margins, and even the profit figure has come in above to what we were expecting at 8,470 crores. Now, when we come to the segmental performance, the JLR EBIT margin has come in line at 10.7%. The passenger vehicle margins are a little better than what we were expecting at 7.9%, while the commercial vehicle margins stands at 12.2%. But specifically, let's look at the commentary, especially from the JLR front, because that's where the action has been happening with respect to US and UK, specifically these particular markets. The company does say that the tariff and the related geopolitical actions are making the operational environment uncertain and challenging, though the company does welcome the deal that has been announced between the two nations. But the global premium luxury segment and the Indian domestic markets are expected to weather this relatively better, is what the commentary is on that front. When it comes to the commercial vehicle business, then they anticipate a sustained growth despite the global headwind, while for the passenger vehicle outlook, and the outlook does remain on the positive side, but the EV business was a bit positive at 6.5%. And also on the JLR outlook, the company does continue to evaluate the impact of the global challenges and will provide an update at the Investor Day on 16th of June 2025. As of now, the planned investment for the next 5 years stands as it is. So all in all, good set of numbers coming in from Tata Motors and also the management commentary.
Srishti for that detail, and as Srishti was pointing in about the management commentary, let's tune into what the top brass at Tata Motors has to say on Q4 turbocharged earnings and just how much Trump's tariff tantrums have rattled the company's sales engine, and also on the flip side, the likely impact of US-UK trade deal.
Firstly, we welcome the India-UK FTA as well as the US-UK tariff change that has been announced by the President and the Prime Minister in the UK. First, take the US versus UK tariffs that were brought down to 10%. We await the fine print in terms of timings. When does it change from when? We also need a few clarifications in terms of what does it do to parts and accessories. But directionally, it's in the right track. Obviously, situation is much better than what we were facing before. But I think we will need to wait for a few days before the final clarifications are issued in terms of notifications and the changes that are there, whether it's applicable retrospectively or not. So those are the things that we await. As far as India-UK FTA is concerned, I think that's again a great development and it augurs well for JLR. At the same time, we also await when the FTA actually comes into force, but we believe this is going to benefit the future cars that are going to come, which means customers will be able to access these global cars at global prices much faster because of this FTA, and therefore it augurs very well for continuing to drive JLR's performance in India. Defender into US is concerned, definitely it has been impacted by the tariffs there, and since it's manufactured out of Europe, it's at a 25% tariff rate even today, and therefore we will treat it as a full portfolio and find ways to see how we can offset the tariff increases that are there. At the same time, we remain optimistic that there will be a deal done between EU and US as well, just like what has happened between UK and US, but we'll have to wait for that to happen. We are hopeful that that will happen sooner rather than later. At the same time, overall, we will have to still need to be focused on delivering growth, focused on delivering our cost initiatives so that we can manage the impact of the tariffs better.
All right, then that's the latest word coming in from Tata Motors management. But let's keep it with the earnings space. In fact, Siemens also reported its numbers for the March quarter. And, if you look at the number on a year-on-year basis, it's fairly a weak quarter. On a year-on-year basis, Siemens revenue stands at 3,808 crore rupees, which is an increase of about 2.5% year-on-year. However, profit has dropped almost 25%, coming in at 674 crore rupees. EBITDA also saw a decline of 23.7% year-on-year, falling to 789 crore rupees, with a corresponding drop in EBITDA margin to 20.7%. Now, if you look at the performance on a sequential basis, Siemens recorded 20% increase in revenue. Profit also almost rose by 20%, while EBITDA increased by 8.8%. However, EBITDA margin, as I mentioned earlier, decreased slightly to 20.7% from 22.8% in the previous quarter. Now, according to the company, it had a flat revenue due to normalization of demand in digital industries and regular project delivery in the mobility business. Profit decline was attributed to under-absorption of fixed costs and higher material costs in digital industries business. Now, looking ahead in the calendar year 2025, Siemens expects an uptick in demand for automation and digitalization solutions as private capex improves.